David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. Today I'm joined by David Guttery, president of Keystone Financial Group here in Trussville, for a discussion about inflation and the impact it's having on bond and stock markets. David, thank you so much. Everybody's talking about inflation. You've been telling us for months that in your opinion, inflation would likely be persistent and not transient. Unfortunately for us, it seems that you were right. But what can you share with our viewers about inflation and recent market volatility? How are the two related, and do you see any light at the end of the tunnel?
Well, if your viewers are looking for evidence of unicorns and rainbows, I'm afraid I'm going to disappoint. Yes, in my opinion, inflation remains stubbornly high, and I am struggling to find anything that I can quantify on a spreadsheet that would lead me to believe that inflation could decline appreciably over the foreseeable future. You're looking at a graphic depicting inflation at the producer level. From March of last year through March of this year, inflation was at 11.2%, and this was an all-time record high. The cost of producing the goods that we consume rose at the manufacturing level by a rate never before seen, according to Haber Analytics. Now you're looking at a graphic that depicts inflation at the consumer level. This is what you feel. Over the same period of time, we have observed inflation rising at 8.5% over the last 12 months. This was the highest rate of consumer inflation that we have experienced since 1981. At a high level, I suppose that would be fine if the average income rose by 10% over the same period of time, so that net after tax, your ability to consume was also increasing by the rate at which it was declining. However, according to the Bureau of Labor and Statistics, this did not happen. Now you're looking at a graphic produced from the Bureau that shows all non-farm payrolls increasing by 5.6% over the last 12 months. Net after tax, let's assume that you got to keep 4.7% of this increase. Clearly, by simply looking at these graphics, our capacity to consume is going backwards. This is important because gross domestic product is 70% consumption. If our ability to consume is going backwards, then that increases the likelihood of seeing a recession, which is simply 2 negative quarters of gross domestic product.
Well, you're right. I don't see any unicorns in that data. David, headline inflation seems to be a persistent problem, but there are other things that we must consume that are inflating at a much faster rate, correct?
That's absolutely true. Think about your income as being a finite capacity to consume over any rolling 12-month period of time. You only have so much money to spend. You're looking at a graphic of a diagram that depicts this concept. Previously, money that you had allocated for economically inelastic things, such as food, fuel, health care, and shelter, claimed a much smaller percentage of your finite capacity to spend than it does today. The more that you must spend on these things, the less that you have to spend in other discretionary places. Typically, as that happens, consumer confidence declines. As that happens, patterns of consumption behavior also change. People become more focused on buying the next gallon of gasoline and the next roll of toilet paper, more so than the next cup of designer coffee. Now you're looking at a graphic of the increase in the cost of fuel. Since May of the year 2020, the national average for a gallon of gasoline has risen by 143%, according to the Federal Reserve Bank branch of St. Louis. In my opinion, food inflation will also likely be higher over the course of this year. The war in Ukraine has significantly disrupted supplies of natural gas. Natural gas is the most important component in the manufacturing of fertilizer. If you haven't noticed, fertilizer is significantly higher over just the last 12 months. This is having an impact on grain growers across the world. In the area of Ukraine and Russia being impacted by war at the present time, a significant amount of the world's wheat and grain are normally produced. I have to ask, to what degree might harvests and yields be lower later this year as a result of the war and exacerbated by skyrocketing costs of agriculture? It wouldn't surprise me to see a loaf of bread more than double in cost by the end of this year. By the time you harvest what was planted and that product is shipped to make flour and then shipped to make bread before it is shipped to your favorite store, and fuel touches it 4 more times in the process, we could be looking at significantly higher food costs. Furthermore, think of how grain touches livestock feed, and you can get a sense for how the inflationary force at a critical level could become much more worrisome over the coming months and quarters.
Well, that's very concerning. We can't live without food, obviously, and fuel impacts virtually every aspect of our lives. David, we're hearing a theme in the general business media that American families have healthy cash savings and can withstand higher inflation over the near term. What is your assessment on that?
Yeah, I believe there is much more to that story than what you are hearing from the administration and from what is being parroted in the general mass media. If households are swimming in excess reserves due to COVID-related stimulus spending, then someone explain to me why the average household is also swimming in debt at the present time. You are looking at a graphic that I sourced from the Federal Reserve Board on the 7th of April, and it shows clearly the percentage change in total consumer credit is at a higher rate than we have measured since March of 2002. If the average household is swimming in cash, then why does it seem that credit cards are being maxed out to their limits? That doesn't make sense to me personally. I believe that any excess in cash that the average household once enjoyed has long since been usurped by increasingly higher costs of inelastic things such as food and fuel.
Well, that's a great question. Well, if the average household is not well capitalized, then can we observe changes in patterns of consumption and behavior at the present time?
Absolutely. I've often said before that confident people spend money. When income is high, inflation is low, taxes are low, then the velocity of money is normally higher, and the consumer confidence is also normally higher. During times such as these, spending on discretionary items is much stronger, and that is usually the hallmark of an expanding economy. Well, now you're looking at a graphic from the University of Michigan. This is the most recent consumer confidence survey. This most recent reading is the 3rd lowest that we have observed since the Great Recession. Tell me that you discern any optimism in that current trend. I believe that we can see this manifest in the most recent retail sales data as well. Retail sales depicts our patterns of consumption and activity in terms of daily items. In 13 of the last 15 months, we have seen retail sales declining. There is a theme in the general mass media suggesting that retail sales are positive year over year, and that is a valid point, but again, tell me that you discern anything reassuring in the pattern depicted in this graphic over the last 15 months. Yes, we can see significant changes in patterns of consumption in both of the ISM readings: durable goods, industrial production, new orders, factory orders, and retail sales. This overlays perfectly with declining consumer confidence and worry over inflation at a time when wages do not seem to be keeping up with the increases in the cost of living.
So, David, let's close with the million-dollar question. What advice are you sharing with clients as you help them navigate this period of time?
Last month, we talked about remaining true to the plan that governs the execution of investment strategies. The strategy itself has not changed, but exposure to the areas of the economy, and by extension, the investments within our portfolios, have changed. As the economy ebbs and flows, there is always exposure that is appropriate for the time at hand. Today, at a very high level, I am encouraging people to overweight the stocks of companies that make the things that you will buy anyway. So this would include things like staples, utilities, pharmaceuticals, precious and industrial metals, and other things that will likely sustain a period of economic softness more durably than other areas of economic exposure. Clearly, this is overly simplistic, and obviously investment direction is individually tailored. Actionable advice can only be rendered following a comprehensive planning process. But the answer to the question is do not stop investing toward the achievement of a planned goal, but rather change the nature of those investments when it's appropriate and when driven by economic changes. This is a marathon, not a sprint.
Well, David, as always, thank you so much for this timely information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.